In 1952, Nicolas Darvas was half of the highest-paid dance duo in international show business. He spent his nights performing in luxury nightclubs across the globe, and he knew absolutely nothing about Wall Street. But that year, a Toronto club owner couldn't pay him in cash for a gig, offering him $3,000 worth of shares in a Canadian mining company instead. Darvas accepted the stock out of politeness. 2 months later, he checked the paper. The stock had skyrocketed, netting him an $8,000 profit. That massive accidental win set a dangerous psychological trap. Like hitting the jackpot on a very first pull of a slot machine, Darvas concluded that trading was easy and that he possessed some natural, untapped genius for the market. He immediately started hunting for hot tips. Working in upscale clubs, he rubbed shoulders with wealthy patrons, headwaiters, and businessmen, asking everyone he met for stock recommendations. He bought shares in companies whose names he couldn't even pronounce, basing his entire strategy on barroom rumors and overheard gossip. The result was a slow, agonizing bleed of his capital. He jumped in and out of 20 to 30 positions at a time, racking up constant, overlapping losses. The market routinely destroys traders who operate on gossip rather than reality. Realizing the tips were useless, he pivoted to serious study. He bought heavy financial publications, scouring the newsstands for corporate balance sheets, dividend yields, and earnings reports. He memorized credit ratings and bought shares in blue-chip companies with spotless financial records. But soon he hit a catastrophic flaw in his new system. He would find a company with perfect fundamentals, glowing prospects, and a strong cash position, and watch helplessly as the stock price completely collapsed. In one brutal trade, a perfectly rated steel company cost him $9,000. Excellent fundamentals on paper simply do not dictate how a stock behaves in the real world. A company's value is entirely dependent on supply and demand. Realizing that his opinions and research couldn't force a stock to go up, he abandoned financial reports entirely and started looking strictly at raw price movement. Staring at hundreds of charts, Darvas noticed that stock prices do not bounce around randomly. They travel in highly defined upward or downward trends over specific periods of time. This chart represents his core observation, which he called the box theory. Notice how the stock's price oscillates between two specific numbers, a low of $45 and a high of $50. This constant up and down movement forms a physical frame, trapping the price action inside a distinct geometric box. Looking at this action, he refused to try and buy at the bottom of a box. Instead, he waited. He only bought a stock the exact moment it violently pierced the top ceiling of its current frame, proving it had enough momentum to establish a new, higher trend. This purely visual framework removed the need to predict the future. He didn't have to guess if a stock would recover. He only committed his capital to assets that were actively proving they were winners by breaking upward. Even with this system, Darvas knew he would still be wrong half the time. So this line shows his strict risk management mechanic, an automatic stop-loss order. The moment he bought a breakout, he set a hard sell price just below his entry point, instructing his broker to automatically dump the shares if the price dropped. Watch the red line as the stock succeeds. As the price breaks into progressively higher boxes, he trailed that stop-loss right behind it. Every time the price established a higher floor, Darvas mathematically moved his safety line up to protect his growing gains. By pulling this safety net up behind a rising stock, he mathematically capped his downside risk to just a fraction of his capital, while leaving the ceiling completely open for massive profit runs. He eventually merged his two phases into a hybrid techno-fundamentalist approach. He selected his candidates based on their fundamental future earning power, but he only executed a buy based on their technical price breakouts on the chart. He specifically targeted rapidly expanding futuristic industries like solid rocket propellants and electronics. Interestingly, he completely ignored what the actual products were. He didn't care about the engineering of a missile component. He only cared that capital was flooding into a new sector and driving up the volume. And he managed this entire operation from thousands of miles away. While touring the globe as a dancer, performing in cities like Tokyo, Calcutta, and Hong Kong, he traded millions of dollars exclusively through coded telegrams, receiving delayed closing prices from his brokers. That extreme geographic isolation actually became his most powerful trading asset. physical distance acted as a natural filter, completely blocking out the noise, panic, and daily rumors of Wall Street. By the summer of 1958, the system had netted him over $500,000. He returned to New York City feeling totally invincible. He began to believe he possessed a literal sixth sense for the market, assuming he could effortlessly master it in person. He abandoned his delayed telegrams and started day trading on the spot. He sat directly by the ticker tape, listened to brokers whispering the latest gossip, and reacted intensely to hour-by-hour price fluctuations. The careful system collapsed. Seduced by the noise, he threw away his stop-loss orders. Driven by greed, he bought stocks at their absolute peaks. When they instantly dropped, fear took over, and he panic-sold at the bottom. Darvas's own uncontrolled emotions and inflated ego cost him $100,000 in weeks. The market remained the same, but his loss of discipline was total. Recognizing that his ears and his emotions were his worst enemies, Darvas constructed what he called an iron fence, a strict set of protocols designed to permanently insulate his strategy from his own psychology. He spread his accounts across 6 separate brokers, so no single person could track his moves. He explicitly forbade them from calling him under any circumstances. His only connection to Wall Street was a single telegram, delivering nothing but raw closing prices, strictly arriving at 6 p.m. every evening. This total emotional detachment gave him back his discipline. When a stock started climbing, he didn't have to fight the desperate human urge to secure a quick, small profit. Insulated from the panic, he just dragged his stop-loss up and let the asset run. By trusting his trailing stop-losses and letting those massive trends unfold without interference, Darvas took his dance tour savings and transformed them into a $2 million fortune in exactly 18 months. Success on Wall Street relies on diagnosing the present, cutting losses with mechanical ruthlessness, and letting a confirmed trend do the hard work.